Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the book Market Wizard's Wisdom, Strategies for Trading Success.
And this book is, it's really a foundational text for anyone who's serious about this stuff. We're talking about a deep, deep look inside the minds of the absolute elite, all compiled by Jack Schwager.
Right.
These interviews, they really capture the secrets of, the top traders from the 80s, the 90s, the early 2000s. I mean, these are people who were getting returns that most of us can only dream about.
And the names are legendary. You've
Okay.
got Steve Cohen with, 45% compounded annual returns.
Yeah, just insane numbers. Paul Tudor Jones, Mark Minervini. Minervini's track record is almost mythical, something like 220% compounded every year for over 5 years.
It's unbelievable. So for you listening at home, you're probably wondering what actually connected all these people, because they all seem so different.
And that's the core puzzle, right? That's what the book really digs into. Because if you just look at their strategies, it's chaos. You've got Michael Lauer in Deep Value looking at these tiny distressed companies.
Right.
Then you flip the page and there's Minervini buying high momentum growth stocks that are already hitting new highs. They couldn't be more different in their approach.
So their methods of attack were completely opposite in some cases.
Completely. The success factor, the thing that allowed any of those strategies to actually work, and more importantly, to survive, was all internal. It was all defensive.
Which brings us right to the core conclusion of this deep dive. The book's main value, its real strategic lesson, is overwhelmingly about risk control and psychological discipline. It's so much more about that than it is about any specific chart pattern or, fundamental analysis rule.
That's the only conclusion that makes sense. It's the only way you can connect a super systematic futures trader like Mint Investment Management with a gut feel stock picker like David Ryan. They had completely different maps to get where they were going, but they were all using the exact same seatbelt.
I love that analogy.
Yeah,
It's perfect.
sure.
So if we frame it that way, the analysis, that's the map. It tells you where you think you should be going.
Mm-hmm.
The psychological discipline, that's the vehicle. The focus, the drive, the ability to actually follow the map. But the risk control,
That's the seatbelt.
it's the seatbelt, the crash helmet, the whole insurance policy wrapped in one. Because without that defense, you're just driving this amazing car with no brakes. And eventually you're going to crash when the map is wrong. And we know it's going to be wrong a lot of the time.
Precisely. So that's our mission today. We're going to pull on those common threads, the risk, the psychology, the systems, market awareness, and just distill out the lessons that still apply today. Whether you're trading crypto or microcap biotech, these things are timeless because they're all about the one thing that never, ever changes in the market.
Human behavior.
Human behavior, exactly.
Okay, let's start with that bedrock then. Risk management. If risk control is the seatbelt, then defining the risk has to be the very first move you make, even before you think about the reward. You said the defense was uniform, even when the attacks were different. So how did that actually play out?
It played out as this constant focus on the potential for ruin. It sounds pessimistic, I know, but it's actually the most optimistic thing you can do strategically because it guarantees you get to stay in the game.
It ensures longevity.
Exactly. Stuart Walton, who managed hundreds of millions, built his entire philosophy on defense. And Richard Dennis, one of the original wizards, he basically laid out the prime directive for all of them. He said, trade small because that's when you are as bad as you are ever going to be. Learn from your mistakes.
That's not just a nice little tip. That's a strategic command.
It is. It's basically saying, look, failure is baked into the system. It's guaranteed. So your success will hinge entirely on how you manage the size and the impact of that failure.
So it's a complete shift in focus. It's not about maximizing the gain on any one trade. It's about minimizing the loss.
And it's about setting those parameters before you're in the heat of the moment, before the emotion takes over.
That's the key.
That's the whole psychological trick. Bruce Kovner, the legendary macro trader, he was all about this. He said the central rule is to always predetermine your exit point. His famous quote. It just flips the whole thing on its head. He said, I know where I'm getting out before I get in. The position size on a trade is determined by the stop.
Wow. So the risk decision comes first,
Mm-hmm.
and that dictates everything else.
Everything else. You make the hard decision when you're rational and calm, not when your account is bleeding and you're panicking. The decision is already made.
And what's so interesting is that so many of these wizards failed, and failed spectacularly early on. It's like they had to experience that ruin to learn the lesson. Is that almost a prerequisite?
A lot of them certainly thought so. Stuart Walton was very open about it. He talked about coming close to bankruptcy, getting these huge margin calls, having to start all over. And he believes that feeling, that deep-seated fear of ruin, is essential.
He said something like, "My having seen the abyss might spare me from making that phone call."
Exactly. I know how quickly things can go bad. Any stock can go to zero, and you need to realize that. It's this profound respect for just how destructive the market can be.
So failure isn't a bug, it's a feature. It's like a high-stakes training program that installs the necessary caution into your brain.
That's a great way to put it. And Walton even used this idea when he was evaluating other managers. He'd tell new investors to look for people who've made big mistakes and learn from them on their own dime.
Not the ones with the perfect track records.
No, avoid them because, as he says, mistakes will happen. And if you've never felt that pain, you're actually dangerous. You don't have that ingrained caution you need to survive when things go really, really wrong.
Okay, so that's the qualitative lesson, the sort of wisdom born from pain. What about the hard numbers? Are there quantifiable rules that we can pull out of this for someone listening who wants to apply it right now?
Oh, absolutely. And they're surprisingly simple. Let's look at the momentum guys, the high-octane growth experts, William O'Neill and his protege David Ryan. Their cardinal rule was rigid. A maximum loss of 7% on any single position, period.
That wasn't a guideline, right? It was a hard rule.
Well, a line in the sand, no excuses, no, let me just see if it comes back. You're out.
So a 7% stop loss is pretty common advice today. But what was the strategic genius behind being so rigid about it? How does that number actually let you succeed?
It all comes down to math and protecting your big winners, which you know are going to be rare. Ryan said he often had only about a 50-50 win rate. That's not amazing.
No, that's basically a coin flip.
Right. But because he cut the losers very quickly at that 7% mark, he could absorb a lot of small losses. Think about it. If you make 10 trades, 5 of them lose 7%, that's a 35% total loss on that batch. The other 5 are winners. All they need to do is average a gain of more than 7% each just to cover the losers, and then a little bit more to make a profit.
Ah, I see. So if your 5 winners average, say, 20% or 30%, which is what they're aiming for with those breakout stocks,
Then those few big winners just completely swamp the large number of small, contained losses. That rigid 7% rule lets them hunt for those explosive stocks without ever having to worry that one bad trade is going to wipe out a whole month's worth of profit. It forces them to preserve their capital.
okay, so that's the high momentum, tight stop approach. How does that compare to a systematic, diversified strategy like the one Mint Investment Management used?
Mint was the complete opposite in some ways. They were entirely systematic, trading futures across dozens of markets. Their risk management was just as strict, but it was spread out. They limited their max risk to just 1% of their total equity on any single trade.
1%.
So if they were managing $100 million, the absolute most they could lose on any one position was $1 million. And they paired that with this extreme diversification, trading across something like 60 different markets.
So why both? Why the wide diversification if your risk per trade is already capped at a tiny 1%?
It's about protecting against systemic risk. The diversification is there so that no single event, say a collapse in the Japanese yen, can blow up their entire system.
Right, because it won't affect corn futures and oil in the same way.
Exactly. So the 1% rule prevents the death by 1,000 cuts if a bunch of trades go wrong at once, and the diversification prevents the single catastrophic event. Both strategies work because they have this unbreakable rule about small, defined risk per trade.
Okay, moving from percentages to something a bit more analytical, I think Kovner's idea of the smart stop is just brilliant. It forces you to connect your risk control back to your original reason for the trade.
It's such a level up in thinking. Kovner argued that beginners make this huge mistake. They place their stop based on the maximum amount of money they're willing to lose, right? It has nothing to do with the chart or the fundamentals.
So they're prioritizing saving a few bucks per share over whether the trade idea is even still valid.
Exactly. And so they put their stops way too tight, they get shaken out by normal market noise, and then they watch the stock go right back up without them.
I think everyone listening has felt that pain.
For sure. Kovner's smart stop is different. You place it at a point that if the price gets there, it means your original thesis was just flat out wrong. So if you buy a stock because it's holding a key support level, your stop has to go below that level, even if that means the dollar loss is bigger.
But hold on, if the analytically correct stop is, say, 15% away instead of 7%, how do you stick to the rule of preserving capital?
And that's the genius of it. Kovner's advice was to then adjust your position size. You still only risk your predetermined dollar amount, say 1% of your total equity, but you apply it to a smaller number of shares with that wider, more meaningful stop.
I see. So if your 1% risk is $1,000 and the smart stop is $10 below your entry, you can really buy 100 shares.
Right. The beginner would try to buy 500 shares, which would force their stop to be only $2 away, and they'd get knocked out by random volatility. Kovner said, and this is the key quote, "Place your stops at a point that, if reached, will reasonably indicate that the trade is wrong, not at a point determined primarily by the maximum dollar amount you are willing to lose." It elevates risk control from just being simple math to being about strategic conviction.
Okay, so if risk management is the defensive blueprint, let's talk about the execution. This is where the human element, specifically the ego, just comes in and wrecks everything. Our thesis said psychological discipline is critical, and Dr. Van Tharp, the psychologist in the book, really gives us the perfect way to understand this.
Tharp's insight is so critical. After studying all these top performers, he basically synthesized it as psychology is the driver and analysis is the roadmap. Analysis is easy. Anyone can look at a chart or a balance sheet. That's just the map.
Right.
But psychology is the driver. It determines if you even bothered to do good analysis in the first place, and more importantly, if you actually follow the map when you're stressed out or greedy or terrified.
And that brutal connection between your mindset and your P&L is summed up in that Ed Seykota quote you mentioned. The one that's really provocative. Everybody gets what they want out of the market.
It's maybe the most challenging thing in the whole book because it puts all the responsibility back on you. It suggests that if you keep losing on some subconscious level, you might be fulfilling a need to fail or reinforcing some self-destructive belief.
Wow.
Yeah. I mean, until you deal with that internal conflict, you're just doomed to repeat the same mistakes no matter how good your system is. Tharp talks about working with this trader who had huge potential, but he could never make more than about 75 grand a year.
Why not?
Because deep down, he had this part of him that believed if he got too successful, his friends and family would hate him and abandon him. So he'd sabotage himself every time he got close.
So the market is just this intense psychological mirror. It finds your deepest insecurities and uses them against your account balance. The number one enemy, then, has to be the ego.
The ego is the single greatest destroyer of capital. Full stop. And Marty Schwartz's story is the perfect example. By his own admission, he was a loser for 10 straight years. Just kept blowing up his account, even though he was a great fundamental analyst.
So what changed?
The big change happened when he finally separated his ego, his sense of self-worth, from his ability to make money.
So what was that specific ego trap he was falling into?
He admitted that the pain of being wrong was worse for him than the pain of actually losing the money. He said, "Before, admitting I was wrong was more upsetting than losing the money. I used to try to will things to happen."
We've all been there.
Right. But the shift was profound. Once he became a winner, his whole philosophy changed too. "I figured it out, but if I'm wrong, I'm getting the hell out because I want to save my money and go on to the next trade." The winners care about making money. The losers care about being right.
But even after you suppress the ego and find success, the book talks about this new danger, the post-victory peril. How does winning itself become a trap?
Schwartz was really clear about this. His biggest losses always came right after his biggest wins. It was just pure carelessness and overconfidence. You start to feel invincible, and you lose that healthy respect for the market's ability to just absolutely humble you.
You lose your discipline.
Completely. He watched another really successful trader who would get ahead by, say, $300,000, and then he'd just revert to all his old bad habits.
Yeah.
Because in his head, it was play money now, or he thought he couldn't lose, and he'd give a huge chunk of it right back.
Yeah.
It just shows that the discipline has to be constant, especially after a big win.
And to maintain that kind of discipline, you need an intensity that, frankly, sounds like an obsession. That seems to be another shared trait.
It's an operational requirement for this job. You hear about Les Garbeau checking the market right after he had major surgery. Cohen and Minervini both say that success isn't a destination, it's a lifetime process. They were obsessed with mastering one single style that fit their personality.
That's a key point. Concentrate on mastering one style that suits your personality.
Because trying to be a value investor on Monday and a momentum trader on Tuesday is just a guaranteed recipe for failure.
And it all comes down to knowing your own weaknesses and building defenses against them. That tragic story about the trader with the 84% win rate, it's a perfect illustration of what happens when you know your weakness but just refuse to deal with it.
Oh, that story is chilling. It's a total morality tale. Here's a guy who was right 84% of the time. Statistically, he's a great trader. And yet, He lost money overall because just 5 trades, 5 catastrophic losses destroyed almost all his capital, and 4 of those 5 disasters happened on expiration Fridays.
A clear, avoidable pattern.
Glaringly obvious, and when his mentor pointed it out, told him to just stop trading on Fridays, his response was just devastating. He said, "Oh no, I can't do that. I can't give up the action on that day."
He knew. He knew that was his kryptonite.
Yeah.
But the psychological need for the excitement, for the action, was stronger than the strategic need to protect his capital.
And that was it. He knew the data, he had the system, but he just couldn't step away from his one big psychological trigger. 6 months later, he was bankrupt. It proves that discipline isn't about some complex algorithm. It's about knowing your limits and having the strength to just walk away.
And sometimes that discipline means relying only on yourself. The anti-broker rule.
This warning comes up again and again in the book, and it's always intense. Minervini and Walden both tell stories about losing everything early in their careers just by listening to someone else's advice.
Minervini said his mistake was surrendering the decision-making responsibility to someone else.
The second you do that, you lose control. You lose conviction. You don't know why you're in the trade, so you definitely don't know when to get out.
Michael Marcus put it even more bluntly. He said, "The leading cause of financial disablement is the belief that you can rely on the experts to help you. More money is lost listening to brokers than any other way."
And the anecdote that drives this home is the one about Watson's college project. He and his classmates did all this research and concluded that a local company was fundamentally just terrible, a clear sell.
But then they saw the glossy report from the local brokerage.
The beautiful glossy report recommending a strong buy, and they just deferred to the so-called experts. They figured, well, these guys get paid big salaries, they must know more than us, so they completely reversed their recommendation in their report.
And what happened to the company?
It went bankrupt not long after. The lesson is just so powerful. Never, ever trust institutional hype over your own hard work and empirical observation. Your own research, even if you're an amateur, is more valuable than someone else's polished but conflicted opinion.
Okay, so we've built the defensive perimeter with risk control and psychology. Now let's get to the offense.
Yep.
The actual strategies. The sheer variety here is astounding. What does that tell us about what's strategically necessary to succeed?
It tells us that being rigid, being an ideologue, is a huge weakness. The market demands that you be flexible. If you cling to one style, no matter what the market is doing, you're eventually going to get run over.
Stuart Walton was a good example of this, right?
Perfect example. He started out as a deep value guy, but he was flexible enough to completely flip his strategy when momentum started working better in the 90s. He said it himself, one year it might be momentum, another year it might be value.
And Michael Marcus pointed out that the easy money from older strategies, like simple trend following, had dried up.
Yeah, that basic trend following worked great in the slower markets of the 70s, but then things got faster, more electronic, and fundamentally, as he said, too many people are doing the same thing. And that just killed the edge. It led to all these false breakouts that would just chop up a simple trend follower. The easy, obvious edges are gone.
All right, so let's explore 2 strategies from the late 90s that were wildly successful but completely opposite. Michael Lauer's deep value and the O'Neill Ryan high growth momentum. Starting with Lauer, 72% compounded annually net of fees. That's just staggering. How did he do it?
Lauer was strategically hunting for inefficiency where no one else was looking, microcaps. These are tiny companies that big institutions can't or won't touch. So he combined classic sheep valuation, 8 to 12 times earnings, price near book value, with 3 critical filters to avoid what he called the dead money trap.
Which is the biggest problem for a value investor, right? You find something cheap and then it just sits there for 5 years doing nothing, tying up your capital.
Exactly. So Lauer's filters were designed to make sure the stock wasn't just cheap, but that it was about to move. First, he needed compelling value, something obvious, like huge revenues compared to its tiny market cap. Second, he had to see insider buying.
And not just token buying.
No, it had to be significant. Another wizard, Okumis, stressed this. You have to look at it in relative terms. If a CEO buys more stock than his entire annual salary, that's real conviction.
And the third filter, the secret sauce, was the catalyst.
Absolutely essential. He had to see a catalyst that will make the stock move in the near future. Otherwise, it's dead money. It could be a new product, a corporate restructuring, anything. And he was ruthless about it. He'd sell a stock that still had 20% upside left if he found a better opportunity with a more immediate catalyst. He was a catalyst collector, not just a bargain hunter.
Okay, so let's pivot from that patient, fundamental approach to the exact opposite. The momentum school of O'Neill and Ryan. Their whole philosophy was basically buy high and sell higher.
And that is so counterintuitive to a beginner. The O'Neill-Cancelam approach was fundamentally against buying cheap stocks. He saw that as a classic amateur mistake. His firm did these massive historical studies of all the biggest stock market winners.
And what did they find?
They found a stunningly consistent pattern. Not some, not most, but every single one of the past mega winners was bought when it broke out to a new high price. The market itself is telling you where the strength is.
So it's two totally different mindsets. Lauer sees a cheap stock and thinks potential bargain. O'Neill sees a stock hitting new highs and thinks confirmed institutional buying.
Exactly. Lauer is accepting the risk that it might take a long time to work. O'Neill is accepting the risk of high volatility in exchange for the confirmation that the trend is already in motion. And Ryan, his protege, added these really strict filters to manage that volatility risk.
The high EPS and relative strength ranks.
Right. He wanted an EPS rank above 90 and a relative strength rank of at least 80, preferably 90. And the insight there, which so many people miss, is they think it's too late to buy after good earnings are already out. But Ryan's work showed the opposite. That's often when the big institutions are just starting to pile in, and that's what drives the stock for the next 6 months.
Okay, finally, let's touch on the contrarians. This requires the most psychological toughness, to just stand completely alone against the crowd. This is Steinhardt's world.
Right. People think of Soros or Jim Rogers, but Steinhardt really defined it with his philosophy of variant perception. The whole idea is to develop a view that's totally at odds with the market consensus, and then you hold that position until the market finally comes around to your way of thinking.
Which means you have to be comfortable being wrong and losing money for a long time. The Gentech short is a perfect example. He was short that stock for a year and a half while it went against him. How do you even survive that?
Well, it comes right back to risk management, doesn't it? His conviction was based on this long-term structural view that the drug Gentech had was going to be made obsolete. His analysis told him the trade was right, even if the market's timing was wrong.
So the position size must have been tiny.
It had to be. Small enough that the daily paper losses didn't violate his overall risk limits. He could stick with it because his core variant perception hadn't changed.
But he also talked about dichotomizing himself. What does that mean strategically?
It's an advanced skill. It means he was capable of holding that deep, long-term bearish view, while at the same time taking short-term long trades in the same stock to play a temporary market mania. He could separate his long-term structural view from a short-term tactical opportunity. That's what separates the pros from the rigid ideologues.
Jim Rogers had a similar, but maybe more patient approach. Hysteria was just a signal for him to start looking.
Rogers only pulled the trigger when the hysteria created an opportunity that aligned with his fundamental worldview. He talked about the gold mania in the early 80s. He shorted gold not just because everyone was panicking into it, but because his macro view, that Volcker would beat inflation and that oil was headed down, gave him the conviction to do it. His quote is great. "Just about every time you go against panic, you will be right if you can stick it out." But that sticking it out part requires doing the homework that no one else is willing to do.
All right, let's zoom out now from individual strategies and look at how these wizards view the entire structure of Wall Street. And it's a surprisingly cynical view that really goes against the academic world. They all seem to operate on the belief that the market is just inherently inefficient.
Oh, they completely rejected the academic efficient market hypothesis, the idea that prices reflect all information instantly, making it impossible to consistently win. The whole reason these guys were successful is because that theory is so often wrong in the real world. O'Neill said it plainly. The stock market is neither efficient nor random because of two things: poorly conceived opinions and strong investor emotions. Greed and fear. Those things create trends that you can exploit.
It's the human error that creates the opportunity. There's that great blunt anecdote that just perfectly sums up their view of the academics.
It's classic. One of the traders talked about his economist friend who kept telling him that trading was pointless because the markets are efficient. And the trader's response was just, "I have noticed that everyone who has ever told me that the markets are efficient is poor."
It's cynical, but it makes the point. It's the cognitive and emotional biases that keep the game interesting for people with discipline.
Exactly. And that's one thing, but Michael Lauer's critique of the institutional world, that goes even deeper. He points out this huge structural flaw. The whole practice of closet indexing. This is one of the most powerful insights in the whole book.
And it feels incredibly relevant today.
Totally. This was Lauer talking back in May of 1999, right before the dot-com bust. He said that a lot of these big public mutual funds, the ones you pay high fees for active management, are really just closet index funds. And the problem is how the fund managers get paid. They aren't judged on making the most money possible for their clients.
They're judged on how they perform relative to a benchmark like the S&P 500.
Exactly. So the goal is no longer make money. The goal becomes don't underperform the S&P 500 too badly.
Which is driven by career risk, fear of getting fired.
It's all about career risk. Lauer explained that if the S&P 500 is soaring because a handful of mega-cap tech stocks are going crazy, that fund manager has to own those stocks, even if they think they're absurdly overvalued.
Because if he doesn't own them and the index keeps going up, he looks like an idiot and loses his job.
Right. But if he does own them and the whole market crashes, he gets to keep his job because he can say, hey, we all lost money together. I didn't underperform the benchmark.
That is just. It's a perverse incentive. The priority is preserving your career, not maximizing your client's profit. How did that actually show up in the market back in 1999?
It created this huge, glaring inefficiency that Lauer could exploit because all the managers were forced to pile into the biggest stocks. The top 50 stocks in the S&P 500 were trading at over 50 times earnings, a 50 PE.
Crazy valuation.
Meanwhile, the other 450 stocks in the index, the ones nobody cared about, were trading at an average of about 20 times earnings.
So there was a 150% valuation gap created just by institutional fear and bureaucracy, not by economics.
It's pure structural inefficiency, and that was Lauer's whole game. He was buying the stocks that the fearful institutions were ignoring, the undervalued small companies with a catalyst, knowing that their behavior was artificially depressing the value stocks and artificially inflating the big index stocks.
And this same conflict of interest, it extends to the sell-side analysts too, people at the brokerage firms writing those buy recommendations.
Oh, completely. Lauer was brutal about this. He said, look, the conflict is simple. Your client wants to make money, and you want to generate maximum commissions. That is the sell-side analyst's #1 priority.
So their incentive is to recommend stocks that trade a lot.
Exactly. They're rewarded for volume, not for being right. So they have this huge bias towards recommending big liquid stocks that everybody already knows and loves. Trying to recommend some obscure small cap value stock that doesn't trade much, that's not a fast lane strategy for an analyst in the sell-side popularity derby. Their job is to be popular and generate fees, not to find you the next hidden gem. The lesson is just never, ever mistake an institutional recommendation for objective truth.
Okay, that structural critique brings us to the final big question. A lot of these interviews are from the 80s and 90s. The world is totally different now. We have algorithms, high-frequency trading. Does any of this stuff still hold up? Are these strategies still valid today?
That's the critical question, and we have to be honest. Certain specific low-tech edges are gone forever. The physical advantages of being a floor trader, gone. The slow spread of information that simple trend following relied on, gone. Any simple mathematical edge has been arbitraged away by computers.
So the classic trend-following models just got run over by the speed of the modern market.
They did. So the specific patterns, the specific PE ratio you look for, those things might not work as well today because they're too well known, but this is the whole point. The lasting value of this book isn't the specific system, it's the philosophy. The timeless framework for risk and psychology. That's the real competitive advantage.
And we still see that same debate today, right? The systematic approach versus the discretionary trader?
Absolutely. The dichotomy is still there. Systematic rules-based approaches are great for consistency and taking emotion out of it, but they're vulnerable. They can break when the market changes or when, like we said, too many people are doing the same thing.
And the discretionary trader?
The discretionary trader, like a Steve Cohen, can adapt on the fly. They can outperform systems. But their vulnerability is all internal. It's the ego, the overconfidence, the fear. They can break their own rules in an instant and wipe out years of good work.
So the key isn't choosing the better method.
No. The key is finding the approach that fits your personality, whether it's systematic or discretionary, and then just relentlessly sticking to it with discipline.
And the reason psychology and risk control are the timeless advantages is because of that one constant.
Human behavior. That's the one thing that doesn't change. The wizards point to speculative manias going back centuries. Dutch tulips, 1980s silver. It's the same pattern of greed and fear over and over again because, as they say, people don't change. You might be trading against an algorithm millisecond by millisecond, but the big multi-month trends are still driven by mass human psychology.
Which brings us right back around to the one strategic recommendation that applies to every single person in any market.
It's that you have to master defense first. Mark Minervini really summed up the entire book in one sentence. The only way to prevent mistakes from turning into disasters is to accept losses while they're small and then move on. That commitment to preserving your capital, to knowing your failure point before you ever click buy, that's the only constant across every single successful strategy. It's what keeps you in the game long enough for the big winners to finally show up.
That was a really deep dive into the wisdom of the market wizards. So we've basically established that success is way less about having a crystal ball and way more about controlling the present. It's about strict risk management and just ruthless psychological discipline. We covered the ego traps, the need for flexibility, and the built-in conflicts within Wall Street itself.
So the takeaway for everyone listening is pretty clear. Go look at your own method, whatever it is, and evaluate it based on its risk rules, not its potential reward. Do you know, to the dollar, the maximum you can lose on every position before you're even in it? And is that stop loss based on real analysis, or is it just based on hope?
And that leads to our final provocative thought for you to think about, building on everything we've heard from these masters. The core insight is that you can quantify your risk, but you can never really quantify your reward. So since the wizards all agreed that knowing your worst-case scenario is the absolute first step, the question is this. If you could completely remove your ego and just stop trying to get even on your next losing trade, what would the immediate strategic outcome be for your capital, and how would that one single act change your entire approach to the market?